Hello everyone, I'm Max Richardson from Investec Wealth and Investment in the UK, and welcome to the latest in the Investec webcast series, Markets and Investment in Times of COVID-19. For over 50 years, investors have coalesced into two distinct groups. Each has strong opinions about their style of investment, how successful it has been, and each tends to look down on the other. The false dichotomy of value and growth investing has a rich history and has become an emotive topic, not just because both have had long periods of outperformance over the other, but because the outperformance of the growth investment style has never been as extreme as it became towards the end of 2020. COVID-19 supercharged the pandemic winners, many of which are found in the internet economy, and we effectively skipped a decade of digitization overnight. But are they mutually exclusive? Can fast-growing companies represent great value, and are all cheap stocks a bargain? Does the rivalry between value and growth investors mask a more profound change occurring in the investment world? What should investors have in their toolbox for the internet economy? Impartial opinion on this subject is hard to come by, since many of the commentators identify with one of the two investment styles. So when Howard Marks released his latest memo in mid-January called Something of Value, covering this precise subject, we thought speaking to him too good an opportunity to miss. Howard's long-standing relationship with Warren Buffett, one of the first true value investors, and his lockdown conversations with his son, Andrew, a successful growth investor, as well as his engaging writing and speaking style, place him perfectly for this conversation. Howard, welcome.
Thank you, Max. It's great to be with you.
So much to talk about and so little time. We've had a number of brilliant conversations in the last few years and covered some really interesting ground about cycles, market history, investor behavior. And I think today's chat's going to be super engaging too. The goal today, as ever, is to challenge the status quo and provide our audience with a fresh perspective. But before we dive into our main conversation, it seems remiss of me not to mention the change in leadership in the US this past week. It'd be great to hear your thoughts on the mood in America at the moment and how the US fiscal landscape might shift under Joe Biden's administration.
Well, Max, I would say that the mood in America is very positive. Our economy is on a good footing, although the current surge in COVID will make the first quarter a difficult one, and maybe the second. I think that worries under President Trump, culminating in his disputing the election outcome and in the invasion of the Capitol building a couple of weeks ago, I think that those tensions are abating under Joe Biden, who is likely to have a more efficient technocrat, experience, knowledge, science oriented administration, and likely to be bipartisan in nature if he can. I'm sure that he wants to calm the worries and act in a bipartisan centrist way. And it remains to be seen whether the Republican Party will go along with that. The Democrat majority in both houses of Congress is minimal. And so they won't be able to get things done based on brute force. It'll have to be a matter of compromise if things are going to get done. We'll see how cooperative the Republicans are in that effort. But I would say that the optimism is high but guarded. The economy is likely to be quite strong for the year, and this is likely to be the beginning of a multi-year recovery. So that's a great positive. The Biden administration, being Democratic and somewhat influenced by the far left, is likely to be more stimulative than a Trump administration would have been, although probably not as pro-business. But I think that the outlook is positive and the mood is high here.
No, that's great to hear. That's great to hear. And obviously with, as you mentioned, such a razor-thin majority in both houses, it'll be interesting to see the priorities or the prioritization they put on their various agendas. And it was great to see certainly from my perspective, and I think from a global perspective, the US rejoining the Paris Climate Accord last week as well.
I'd like to add that the greatest worry in the business community with regard to a Biden administration was the possibility that if the Democrats controlled the Senate and the House and the White House, they would implement a leftist program of redistribution and of business regulation. I think that the fact that of the narrow margins has eased that concern. And that's one reason for the stock market's positive behavior on balance in the 2.5 months since the election. Very true,
very true. So, I mean, much to anticipate this year, and we certainly look forward to see what the developments will be in the stock market. So let's dive into the conversation that I outlined earlier on. As I said, I think this is going to be a really fascinating conversation. But let's begin with some context. You wrote about the dominance of the value investing style for much of the post-war period. Can you describe the history of the growth and value investment styles and introduce some of the main characters in this fascinating story?
Well, if you go back 100 years to 1920, I would say that there was no such thing as an investing style. Now, I may be wrong. I wasn't alive at the time, but I don't hear about there having been investing styles. There were some styles of manipulation of the market and so forth. And Wall Street wasn't regulated. So it was pretty much the Wild West. But I don't think there were investing styles. The first style that came along was what is now called value investing. And I would say it was started in probably around 1950 by Ben Graham. And Ben Graham was Warren Buffett's teacher at Columbia and an early fund manager. And he practiced what we now call value investing. I don't think he called it value investing. Warren Buffett calls Graham's style of investing, which Buffett adapted in his early days, cigar butt investing. In other words, he looked for cast-offs that one would find in the gutter, cigars that maybe had a puff or two left in them that he could pick up for nothing. And that was the style at the time. You have to understand that this was what I would call a dumb environment. There was no data, there was no computers, there were no spreadsheets, no screening programs. If you wanted to get information on a company, you would have to write to the company and ask for their annual report, and they would have to send it back once it went through their administrative process, all of which took a lot of time. Or you could look through publications, dense publications that had data on companies, which most people did not bother to consult. And so somebody like Graham or Buffett could find little known situations where they could really scoop up incredible bargains because of other people's ignorance. Graham was very successful at that. Buffett did that, but then segued because of his connection and based on the advice from Charlie Munger to what we all call now, what he calls great companies at fair prices. So again, value is not immutable, but over time, I should say that in the 60s, there arose something which is now considered the polar opposite, which is called growth investing. And growth investing was considered to be the investing in great companies, fast-growing companies, which sell expensively but are worth it. And that grew into something called the Nifty 50. And in the late 60s, by the time that I joined the business in 1969, or my first summer job in the business in 1968, the banks, which were the main investors of the time, many of them practiced Nifty 50 investing. The 50 greatest and fastest growing companies that were so wonderful that A, nothing bad could happen, and number two, so wonderful that there was no price too high. And as a consequence, they sold at extremely high prices, mainly expressed as PE ratios, price to earnings ratios. The normal PE ratio since World War II has been 16 times earnings, and many of the Nifty 50 sold at a multiple of 16, 30, 50, 70 times earnings, some cases 90 times earnings, but of course it was worth it because they were such great companies. Well, if you bought them the day I started work in 1969, and if you held them for 5 years, you lost almost all your money in the greatest companies in America, because the stock market roughly halved, and the Nifty 50 did even worse because they fell from their elevated valuations. But anyway, there arose this dichotomy that you discuss between growth and value, and it persists to this day, and it is the main organizing principle in the equity management business. And people say I'm a growth manager or I'm a value manager. And growth is basically thought of as great companies rapidly growing. Primarily that means technology and biotech, albeit at high valuations, or prosaic, slow-growing companies bought cheaply, which means low valuations. And as you say, and as even Buffett would say, as I quote him in the memo, I think it's an artificial dichotomy used to organize the equity management business. And I think, as you say, not useful.
Indeed. I mean, I think really you could describe them both as being two sides of one coin, basically, value and growth. We're both trying to achieve the same thing, which is to exploit an expectations gap between market expectations and what companies might actually achieve. And that's a great context setting, actually. The 50s were a real turning point, because before that, market movements, I think, were dominated really by speculation. And you had, you know, the famous book of Jesse Livermore and Reminiscence of a Stock Operator, which was really the kind of the founding investing book before security analysis came along. And of course, Ben Graham and Buffett then sort of championed this whole idea. But there's a great story in your memo, which I hadn't come across before, about Warren Buffett and the National Fire Insurance Company. Can you just tell us about that story, because you know about it?
Well, as I understand it, National Insurance was an example of the cigar butts that I described. You know, Buffett, being what today you would call a nerd, you know, would sit in his back porch in Omaha and leaf through what we call Moody's Manual. It was a big publication. It was about this thick, and it consisted of thousands of pages of very, very thin paper, thousands of pages of paper, with the financials and a description of every public company. And of course, you know, very few people, only the nerds, would read it, and that would leave tremendous bargains for the people who would go to the trouble. So, you know, Buffett read about something called National Insurance, and it had been sold to rural investors years before by promoters who probably bought it for 10 cents and sold it to people for $1. And Buffett would drive around and meet with farmers on their porch. They probably forgot that they had it, and they would dig it out and they would sell it to him for what he thought was too low a price, and he would pay him in cash on the porch. And he made a lot of money with it. But that's just one example of how people found and bought cigar butts.
That's a great story, the National Insurance Company story, one that I hadn't come across before, and just shows the power of that cigar butt theory. You mentioned the Nifty 50, and that was a period of phenomenal returns and a marked period in stock market history. What lessons did you learn from that period? But more importantly, what shouldn't we be careful about applying those lessons perhaps to growth companies today?
number one, it was a very educational experience for me. As I said, it was the experience of my first 10 plus years in the business. And as I said, if you bought and held the stocks of the best 50 companies in America, you lost almost all your money in a very short time. And in 1978, because I was part of the effort that invested in the Nifty 50, I would imagine I should have come close to losing my job, but rather I was asked to start portfolios in convertible bonds and high yield bonds, which worked out very good and is the core of Oaktree. But now I'm buying the securities of the worst public companies in America, making a lot of money safely and steadily. So the lessons I learned that number one, it's not what you buy, it's what you pay for it that determines whether you'll be successful or not. And number two, successful investing is not a matter of buying good things, it's a matter of buying things well. And I think that's a very important distinction, which has guided the rest of my career. And I guess you only learn lessons from failure. You don't learn much from success. And B, it's great if you learn those lessons early in your career so that they can have a positive influence on your career. But that was the lesson of the Nifty 50. But there are many other lessons to be learned. Number one, a great example of the Nifty 50 was Coca-Cola, a terrific company. And it was one of the companies that lost most of its value between mid-1972 and the end of 74. It was another company that had been highly valued and fell to earth. But another important lesson is that Warren Buffett, the high priest of so-called value investing, is perhaps best known for his investment in Coca-Cola, which certainly was not a cigar butt. It was certainly, when he bought it, a great company at a fair price. And even if you bought it at the high in 72, if you held it for the next 26 years, you made a double-digit return for 26 years. And if you can compound your money at a double-digit return for 26 years, you made a lot of money. And Buffett did. And that's one of the stories that is responsible for his success. So I think that's another important lesson. Buffett was not dogmatic about it. He says we don't practice something called growth investing or something called value investing. He didn't make that dichotomy, and I think others shouldn't either.
It's a great example, actually, of the adaptability of Buffett's investment style, basically, that he adapted from cigar butt to moat investing, as he in Munger terms coined that phrase.
And one of his most successful investments was in Amazon, which nobody would call a value investing, but I think he saw good value there.
That's true. Well, I mean, Amazon and Apple, I think, both feature in the Berkshire portfolio now, and it was about opportunity. Cigar butts were the opportunity immediately post-war. Then it became moat investing, and I guess that coincided then with the downward trajectory, certainly from the late 1980s, early 90s in interest rates, which perhaps helped that style of investment. So I think it's important that we kind of contrast what the investment world was like between the late 1960s and now. I mean, back then, investment professionals were relatively rare, and I think probably earned the same as many other professions at the time. A lack of information and analytical tools meant that bargains were plentiful, i.e. markets were mostly inefficient, and Buffett was a relative nobody. Today, of course, Warren Buffett is a celebrity. Tens of trillions of dollars are managed professionally. We have lightning quick computing power that allows vast amounts of data to be analyzed instantaneously. Investment careers are very desirable, and markets are efficient and certainly very competitive. How has that change really contributed to the change in opportunity for investors and the evolution of investment styles? You wrote about this in the memo.
Well, I think, Max, that you recap broadly the significant changes that have taken place. First, from 1920, a disorganized industry, 1960, what we call an inefficient world, which means to say, not systematically studied, and consequently, you could steal things like national insurance, and I say that figuratively speaking. Buffett didn't really steal it; he just bought it laughably cheap. To today, when the industry is organized, populated. When I was getting out of school, graduate school 50 years ago, I applied for 6 different jobs in 6 different industries, only one of which was investment management, and they all offered the same salary, $12,000 to $14,000, and that wasn't a month. But today, as you say, careers in investing are highly sought after, and we think of the industry is much more efficient. Certainly, one shouldn't think that there is that based on publicly available information, it's possible to get extreme bargains like Graham and Buffett did. Rather, I think it's reasonable to think that if things are available at extremely low valuations, there's probably a good reason. They probably deserve it. And if things are expensive, there's probably a good reason for that too. They merit it. And so, I think that the thought that you can study publicly information about the present, and get rich from that is probably ill-conceived. What that means is that if the study of publicly available quantitative information is not going to be very profitable, then to be extremely successful as an investor, you have to either deal with qualitative information about the present, the quality of a company's employees, engineers, thought process, product development capability, distribution capability, or guesses about the future, or both. Mere processing of quantitative information, which is currently available to everyone, is not going to produce exceptional results.
Yeah, indeed. This is an area that I wanted to explore with you, this friction, if you like, or the opportunity between quantitative and qualitative analysis. And you mentioned this in the memo. It's a great way of putting it that in the past, a company's assets resided on the balance sheet. And these days, some of the best company assets go home every night to their families. And there's been this shift, obviously, from sort of tangible to intangible assets. And you wrote about the difficulty of attaining edge using quantitative techniques in efficient markets. How does our investment toolbox need to evolve to create competitive advantage as investors these days? So, for example, it's quite clear that we should place, from your writing, that we should place more emphasis on qualitative judgment now. But specifically, one of the areas that you didn't explore in the memo was sustainability. And I wonder how your thought processes might have evolved in relation to qualitative judgment and sustainability in the future, because you mentioned complex, the world becoming ever more complex, and this whole world of ESG and sustainability seems to add a whole new universe, if you like, of complexity to that process.
Well, certainly, when you have to deal with qualitative information and estimates of the future, it's much harder to reach a confident and correct judgment than if you're dealing with quantitative information about the present. If you say to 100 investors, tell me about XYZ's current financials and operations, they'll all use the same facts, data, and they'll all probably reach conclusions that vary very little. But if you say, tell me about company ABC's product capabilities and what they're going to earn 10 years from now, you'll get a much wider range of opinions. And the difference between being right and being wrong will be much bigger. And that difference of opinion creates scope for big wins and big losses. So it's a very different world. One of the things that makes the future more uncertain is ESG, impact investing, sustainability issues. Which companies can contribute to the well-being of the world 10 or 20 years from now? Which industries will come under a cloud? Which industries will be disrupted and extinguished because they're not relevant to the future? This is a very important decision, and not made as easily as the question of what the current finances are. It's just one example of the things we have to consider, and it's obviously very new. Nobody thought about these things 20 or 30 years ago. By the way, it's not such an easy decision either. The results are never clear-cut. I can tell you, for example, that I saw a study of the performance of, I think it was probably the Dow, could have been the S&P, but either the S&P or the Dow, in the 70s, 80s, and 90s, a study that was done early this century. And they looked at all the companies in the index, and they said which ones grew at 15% or more, or returned 15% or more in each decade. And there were only a few companies that grew at that returned 15% in each decade. There was only one that returned 15% for all 3 decades. And it was Philip Morris, a cigarette company, which was certainly the least socially responsible of all, and the most successful. So, we're going to try, the investment industry is going to try to emphasize the companies that will be best for society. There's not necessarily a one-to-one correlation to an investment success. So what we have to figure out is not which are the best companies for society, but which are the good companies that will have good returns.
I think that's right. The financial industry sits at this hugely important and pivotal place in terms of the future of our planet, and indeed environmental, social, and governance concerns, and the way that we act in the coming decades will have a profound effect. But the impact on the actual returns that can be gathered, I think, will be more nuanced perhaps than picking.
But I think importantly, clients are asking us these days to harmonize thinking about social responsibility and sustainability with thinking about investment returns. Many of our clients tell us to consider both.
Very sensible indeed. I want to turn back to the internet companies, because the internet stocks seem to be characterized by strong network effects, high margins. Again, you wrote about this in the memo, high margins on incremental sales and fast, low friction growth in truly global markets, leading to things like increasing returns to scale, which again, you mentioned Brian Arthur in his work in your memo. So I'm going to mention a value investing phrase here, which has become almost like religion to most true value investors, which of course is reversion to the mean. Can we rely on reversion to the mean to predict the future of a stock or industry in this ever-changing world characterized by those points I just made? And what's the mindset, crucially, what's the mindset that will be successful in the coming decades?
Max, when I was a young man, the world felt like an unchanging place. The world didn't change much from year to year, not that much from decade to decade. It felt like the environment was a stage set in a play, stable, static, not changing. And changes in companies and economic and market cycles played out in front of that backdrop. Today, the world changes every day. And the companies that were successful 10 years ago, many are not successful today. Many of the companies that are successful today didn't exist 10 years ago. And this is a great change. And we can't ignore this. We have to factor it in. We have to change. In addition, as you said, you mentioned earlier that the old companies were capital intensive and asset intensive. They produced a physical product and they produced it in a physical setting of factories and equipment, which was expensive. And so if they were going to expand, double, triple their sales, they had to add double, triple their machinery and have access a lot of money to do so. We've never had companies as profitable as today's, with growth potential of today's, and with a reliance on code and digitization, engineers rather than equipment. If a software company develops a desirable app piece of software and they produce 100, it costs several million. The next 100 costs almost nothing. And then the 100 after that costs almost nothing. So incremental profitability is extremely high. Reliance on assets is extremely low. Just the other day, 2 days ago, I was looking through charts and I saw a chart of the ratio of price to book value of the average tech company. And this is one of the things that people looked at. Book value is the net of your balance sheet. It's the assets minus liabilities. And the ratio of price to book value of the tech companies and software companies was extremely high. In other words, they looked expensive, and a value investor wouldn't buy them because the multiple is so high. But the truth is, they don't need assets. So they have few assets, and as a result, they have this high ratio of price to assets. But it's meaningless because their potential profitability is not asset-based. It's idea-based. It's code-based. So the rules of the past, and certainly the rules that constrain the value industry, for which low valuation multiples like price to book, price to earnings, price to sales, those ratios are the sine qua non of value investing, but not as relevant in the new world. So I think that's a great example of how our thinking has to modernize, and a great example of what I learned from being cooped up with Andrew for much of the pandemic so far.
I mean, it sounds like being cooped up, as you put it, led to some really interesting conversations. And it was great to be able to get some insight into those conversations.
And that's what I think that I was maybe even too subtle in naming the memo. That's the something of value. And it's not a pun on value investing. It's the fact that our spending time together was so good for me and so helpful to me in evolving my thinking.
Yeah, and that came across very much so. We've talked today about regime change, I guess, if you like, in many different ways, from speculative investing pre-1950s or pre-war to investing, from periods of cigar butts being the opportunity to moat investing, and then more latterly technology being the opportunity. And I think the other big regime change is the one that you've just described, of long periods of stability, which was the post-war period, and now we're in a period of exponential change. And that's for many of the reasons that we know, but largely because of the profound impact of the internet. And when you have periods of exponential change, it means that option value, or your options, as it were, become more valuable. And there's no way that we could have known, for example, just how successful all the options available to Amazon, what they might have been in 1997, and how they might have exploded as it got bigger and bigger, and access more capital and more knowledge, for example.
I want to make 2 points. The most important is that I'm not saying forget value investing, you have to invest in growth. Forget mundane companies, you have to invest in technology. What I'm saying is you have to have an open mind. You have to consider using all the tools in your toolbox. I'm not saying that fast growing companies are important and inexpensive companies are unimportant. Anything can be overvalued and thus likely to produce a poor return, or undervalued and likely to produce a good return. It's certainly possible for high growth tech and biotech companies to be so overpriced that they represent poor investments. Remember, it's not what you buy, it's what you pay for it. And I'm not making a commentary on the current market. I'm not saying that tech stocks are inexpensive or likely to produce high returns or should be bought. What I'm saying is that investors should not rule out things. I mean, there's no reason why a fast growing company can't be good value, or why a low multiple company can't be a good investment. But rather than say which is attractive today, my message is that investors should be broad-minded and open-minded.
I think that's the key takeaway, and certainly something that I learned from your memo and that has come through loud and clear, is that this is two sides of one coin, and actually keeping an open mind is absolutely the right way to go about it. There are clearly, polarized camps who talk about this a lot, but understanding both points of view is probably the key to success in the future. Two final questions from me. The first one about how your thoughts have evolved in relation to financial innovation. You talked about cryptocurrencies briefly in the memo, and perhaps we don't need to go into too much detail about those in particular, but financial innovation throughout history has been something that has invariably ended in disaster. And I'm not asking for you to opine on whether you think crypto will end in disaster, but how has your thought process evolved in respect to financial innovation in these ever-changing times?
Max, I'm naturally a skeptic. I think that's the big part of the value investor mentality, is to be skeptical about things that are promoted as being panaceas. And a lot of my success has come from turning a negative when I thought the environment was too optimistic. My general conclusion and my general experience over my life has been that financial innovation, whether it be portfolio insurance in the 80s or mortgage-backed securities in the noughts, is only possible in optimistic times, because in pessimistic times, people won't adopt the new. They adopt it when everything's going well and people are optimistic. And it is because it doesn't have to stand muster scrutiny that much of financial innovation has ended in tears, as you say. And so my knee-jerk reaction to cryptocurrencies when they first became prominent a few years ago was to be skeptical and to say some categorically negative things about them. And the reason I mentioned them in the memo was because, number one, that is an illustration of how our biases can affect our conclusions. And number two, it's clear to me, with Andrew's help, our children help clarify things for us, it's clear that my knee-jerk reaction was based on natural skepticism rather than information. I didn't know that much about them, but they seemed to me to be not investable because they didn't have tangible value, which is what a value investor looks for. Andrew has taken me through a course of education with regard to cryptocurrencies, and I understand now the case for them, which is based on supply and demand. Demand may grow from investors or from users for these currencies because of their qualities, and the supply is limited by the technology, and an excess of demand over supply can produce a rising price. Well, they don't have tangible value. There's no earnings behind them, no cash flow, no assets. But isn't that true of currencies? Isn't that true of the euro or the dollar? The dollar used to be backed by gold and silver. Today, of course, it's not backed by anything. Well, why is the dollar or the pound sterling desirable? Because other people accord it value and will accept it in exchange for goods, for example. Well, isn't that true? If that's true of Bitcoin too, if it's desirable and acceptable, then Bitcoin may have a role. So I've switched from knee-jerk skepticism to trying to understand the other side. I haven't concluded yet whether that makes it a good investment or desirable, or whether it justifies the price increase that has taken place, or whether it's worth much more than today's price. But what I'm talking about here is process, and again, open-mindedness. And I think Andrew's most important point is not that X is good or B is bad or J is undesirable. His basic point is that we shouldn't generalize. We shouldn't have a knee-jerk reaction. We shouldn't say that a company is not attractive because the PE is high, or that another company is compelling because the price is low. But look at the whole thing based on a deep understanding.
Very good. And of course, all those currencies that you mentioned, have learned over the last 10 years that there's almost infinite supply of those. So that's a key differentiation. My final question is about writing, actually, because you write so well about subjects that are not that easy to understand for the average person on the street, but you write them in a way that I think most people would certainly understand and engage with very closely. Perhaps you can give us some tips and perhaps talk us through the process that you went through for your latest memo, which I think was perhaps one of your longer ones. You know, how long did that take? Do you sit down and do it all in one go? What's the process?
Depending on the urgency, and of course this one had no urgency. I mean, the one I put out right after Lehman bankruptcy in 2008. September 15th, 2008, I wrote it. I started on a Monday and it was published on Tuesday. But this one, when there's no urgency, they take a month, 3 months. What if they're academic? This probably took about a month, and Andrew and I worked on it together. But I write a section at a time and stop. I write when I feel like it. I'm not like an author who says he has to write 100 pages every day or something like that, or 100,000 words. I do it because I like it. I'd rather work than not work. I'd rather write than sit in the sun. For me, it's a creative outlet. I will say that the response to, I'm now entering my 4th decade of writing the memos. A lot of people, this one created more response than any other in all the time, and a lot of people wrote it was the best of all. So that's a great thing for me. Of course, the opportunity to work with Andrew on it was, and we did it back and forth and iteratively, and his contribution was immense. That made it the greatest of all for me.
Well, as you know, I've read many of your memos, and I certainly found this one to be the most informative. So I would wholeheartedly agree with the sentiments of your other readers that it was brilliant. So we're immensely grateful for you for joining us so soon after writing it as well. You're clearly in high demand for other people wanting to talk about the same points and issues. So Howard, thank you so much for joining us today.
Well, we're proud of and happy with our work with Investec, and so coming on with you was one of my high priorities.
Very kind. Very, very kind indeed. Thank you.
Okay, Max.